Welcome to the Deep Dive. Today, we're looking at a day that really shook things up, fundamentally changed how we saw markets, technology, maybe even human nature itself. Black Monday, October 19th, 1987.
Yeah, and it's interesting. When you say market crash, people often picture 1929. Right?
Exactly. You think of that roar from the trading floor, shouting, paper flying everywhere, just raw panic, really visible.
But 1987, the sound was different. Our sources, they describe it less as a roar and more like this low, constant hum.
The hum of computers.
Yeah, thousands of those old beige CRT monitors. And then sort of punctuating that, the whine of dot matrix printers just churning out paper. It wasn't human despair, not at first anyway. It was the sound of a system.
Yeah.
A system that thought it had it all figured out.
Perfected almost. Logic over emotion.
Precisely. Believing they'd finally conquered that messy human element.
Okay, so let's dig into this. We've got a pretty deep stack of material here. It covers the lead up, this massive 5-year bull run that kind of fed the whole thing.
Right, the financial hubris, you could call it.
Yeah.
And then there's the tech itself, portfolio insurance, this really sophisticated defense mechanism that we'll get into how that played out.
And crucially, the human side, too. The interventions that had to happen to stop the whole system from just collapsing in on itself.
So our mission here is to kind of synthesize all this for you, the listener, give you the quick but thorough rundown. Because the core of it, the paradox, is that Wall Street truly believed the ghosts of 29 were gone.
Bird, yeah.
They thought automation, speed, efficiency, that equaled safety.
Which leads us to the big question, the real irony we need to unpack. How did the very technology designed to prevent panic, to protect these huge portfolios, how did it end up causing a crash nearly twice as bad as the worst day in 1929?
That's the puzzle.
Right. So let's start with the setup, the context. You really can't understand the crash without understanding the party that came before it. The 1980s, it had this specific cultural feel, didn't it? The rise of the yuppie.
Oh, absolutely. Young, urban professional. It was everywhere. Ambition, wealth, glamour, it was all very unapologetic, very loud.
Popular culture was saturated with it.
Yeah, the accounts we reviewed mentioned shows like Dallas, Dynasty. They weren't just soaps. They were almost like instruction manuals. They made that high roller lifestyle look like the ultimate goal. Money wasn't just power. It was like proof you were smarter, better.
And the philosophy backing it up was just as loud. This gospel of greed. Oliver Stone's Wall Street obviously captured it perfectly.
That Gordon Gekko line, yeah.
Yeah.
Greed, for lack of a better word, is good. It became shorthand for the whole era.
But it wasn't just a movie line, was it?
No, not at all. That's often missed. The real-world source, we traced it back to Ivan Bokhetsky, the big arbitrager, corporate raider guy.
Right. Infamous, maybe?
Yeah. May 18th, 1986. He's giving a speech at UC Berkeley's business school graduation. And he tells these grads straight up, greed is all right, by the way. I want you to know that. I think greed is healthy.
Wow. Just saying it out loud.
He followed it with, you can be greedy and still feel good about yourself. So this wasn't some hidden motivation. It was the explicit creed. Free market economics, especially the Chicago school thinking, really embraced it. Unregulated systems work best. Self-interest ultimately helps everyone.
And the market just kept proving them right, didn't it? For 5 solid years.
The numbers are just wild. They really fuel that sense of invincibility. You look back, August 82 onwards, this historic bull run. The Dow Jones, the big benchmark, everyone watched it, went from about 776 points.
Which sounds incredibly low now.
Doesn't it? All the way up to a peak of 2,722 in August 87. I mean, that trajectory is almost unbelievable.
And the speed, especially right before the crash.
That's the kicker.
Yeah.
Just the first 7 months of 1987, the market surged something like 44%. Imagine being a trader then. You didn't just feel good, you felt like you'd cracked the code, like gravity didn't apply anymore.
And it wasn't just a U.S. thing.
No, it was global. The 19 biggest stock markets globally, on average, were up almost 300%, 296%, I think, in that same 5-year window. The confidence was absolute.
Okay, so into this roaring party, this very confident, maybe slightly testosterone-fueled environment, steps a very different kind of figure, the new Fed Chair.
Alan Greenspan. Yeah, August 11th, 1987, just 2 months before it all hits the fan. He's sworn in.
And he's the total opposite of the trading floor vibe, right? The economist's economist.
Exactly. Subdued, intellectual, glasses, known for dense analysis, not a cowboy. He had that famous joke about central banking that the key skill was learning to mumble with great incoherence.
You don't spook the markets.
Right. But behind the mumbling, his core philosophy is critical here. Greenspan was a serious follower of Ayn Rand's objectivism.
Which champions?
What?
Pretty much a pure form of capitalism with minimal regulation. His fundamental belief was that markets are rational. They work best when left alone. They'll correct themselves. So his instinct wasn't intervention. So if things got too hot, his view was, let it burn off naturally.
Essentially, yeah. Stand back, let market forces work. And his first big move as chairman showed that commitment, though the timing, in retrospect, was not great.
What did he do?
Well, the economy was booming, maybe overheating, inflation fears were rising, so acting like a classic free market hawk on September 3rd, just weeks into the job.
He nudged interest rates up.
Correct. A clear signal. He was basically telling the market, look, my job is stable prices, a strong dollar, not pouring fuel on your speculative fire. It was signaling non-intervention, a willingness to accept some pain for stability.
Right as the market was hitting peak altitude and starting to wobble.
Exactly. So you've got the perfect storm brewing.
Yeah.
This euphoric, seemingly invincible market fueled by tech and greed.
Colliding with a new central banker philosophically committed to letting it find its own way, no matter how rough the ride. The logic was about to be tested. Hard.
Okay, so to really get why this crash was so much worse than 29, we need to talk about the main character, or maybe the villain, depending on your view. It's not a person. It's an idea.
Portfolio insurance. PI.
Right. The sources we've looked at call it things like elegant, brilliant, but also ultimately catastrophic.
An elegant catastrophe. I like that. So where did it come from? What was the problem it was trying to solve back in the mid-70s?
It starts with Hayne Leyland, a finance professor at Berkeley. He's grappling with this big institutional headache. How do you protect massive funds, pensions, endowments from those really brutal crashes like 73, 74 that just wipe people out?
Selling stocks was the obvious answer, but then you miss the upside when it recovers.
Exactly. Leyland's insight was connecting real-world insurance to financial theory. He realized you could model insurance mathematically as a put option.
Okay, remind us, a put option is the right to sell something at a set price later. Insurance against the price falling.
That's it. The breakthrough was the Black-Scholes option pricing model, which was new then. Leyland figured out he didn't need actual physical put options, which could be pricey or hard to trade. He could create a synthetic put option.
Using computers.
Yes, a computer-managed strategy for the whole portfolio. He partners with Mark Rubenstein. They formed Leland Rubenstein Associates. And their goal, genuinely, was noble. Keep the big, cautious money in the stock market during the good times, get that upside, but without the risk of getting completely hammered on a bad day.
Taming the market with math.
That was the dream.
So let's use this magical seatbelt analogy. How did the program, the dynamic hedging, actually work in practice, minute by minute?
Okay, so imagine the seatbelt is always checking your speed, your trajectory. The program constantly monitored the portfolio's value. If it detected a drop, not just a panic sell-off, but any meaningful dip.
It didn't wait for human confirmation.
Nope. It automatically kicked into dynamic hedging. And this wasn't just selling the stocks you owned. It was more sophisticated. The program would sell stock index futures contracts, usually S&P 500 futures, over in the Chicago markets.
Why futures in Chicago?
Because that market was incredibly liquid and efficient. You could trade huge volumes quickly without moving the price too much, theoretically. So the program sees the New York portfolio value dipping. It instantly sells futures in Chicago.
And the profit from selling those futures would offset the loss on the actual stocks.
That was the idea. It created this theoretical floor. No matter how far the market fell, your losses were capped. It seemed watertight, logical, automated, perfect protection from panic. What could possibly go wrong?
Famous last words.
Indeed. What went wrong was adoption, scale. Wall Street loved this. Upside potential with supposedly limited downside. They piled in.
How much money are we talking about?
The estimates vary, but the analysis suggests by October 87, somewhere between $60 billion and $90 billion worth of assets were under this kind of insurance. That's a colossal amount of money, all following the same logic. Everyone thought it was foolproof.
Because an algorithm is rational, right? Unlike those panicky humans.
That was the belief. Cold logic would prevail.
Okay, but here's the flaw, the systemic issue. If everyone has the same magic seatbelt, programmed identically, reacting to the same data, and they all slam on the brakes the exact same instant.
You don't just stop safely, you get a catastrophic multi-car pileup, mechanically induced. The core issue was that the strategy required selling into a falling market to hedge.
It had to sell when prices were already dropping.
Yes, and when you have potentially $90 billion worth of systems all programmed to hit sell simultaneously based on the same trigger, the sheer volume just overwhelms the futures market.
Yeah.
Futures prices plummet violently, way faster than humans could react.
So the protection becomes the crash.
It becomes the accelerator. It creates this instant mechanical feedback loop. The defense mechanism turns into the primary weapon of destruction. The synchronized selling was the key.
The computer wasn't the rational defender. It was the first lemming off the cliff, programmed to take everyone with it.
A grim way to put it, but yeah.
Yeah.
The speed and interconnectedness, amplified by the machines, became the enemy.
Okay, so the system is armed, incredibly sensitive because of its size, but it needs a spark, a trigger. October 19th wasn't just out of the blue. There were warning signs, events building up pressure.
Absolutely. It wasn't random. The first real wobble came Wednesday, October 14th. Big news.
Right.
The U.S. trade deficit numbers came out much worse than expected.
Market didn't like that.
No. It hit confidence in the U.S. economy. The dollar started falling. And the immediate reaction was, okay, Greenspan's Fed is going to have to raise interest rates again to defend the dollar.
Right.
Which, of course, is bad news for stocks.
So the Dow dropped?
95 points, which back then was a record one-day point loss. Seemed huge at the time.
That record lasted, what, 2 days?
Pretty much. The pressure didn't let up. Friday, October 16th, things got much worse. Real signs of panic setting in. The Dow plunged another 108 points. That's a 4.6% drop in one day.
And psychologically, seeing the market down 10% in just 3 days after that relentless climb.
It was a massive shock. Plus, that Friday was a triple witching day.
Right, when different options and futures contracts expire together always adds volatility.
Exactly. So the market was already jittery, already under pressure. But then external factors pile on, something totally unexpected.
Nature itself, the great storm.
Yeah, incredible detail. Thursday night into Friday, this massive storm, basically hurricane-force winds, batters the UK. The London Stock Exchange on Friday the 16th effectively closed. People couldn't get to work. Systems were down.
So what did that mean for the markets?
It meant a huge backlog of sell orders got trapped in London. Like water building up behind a dam, all that selling pressure couldn't get out, just waiting for Monday when things reconnected globally.
A pressure cooker.
Yeah.
And then politics throws more fuel on the fire over the weekend.
Right. Saturday, Treasury Secretary James Baker makes this public threat. He says, basically, if other countries don't cooperate on currency stabilization, the U.S. might just let the dollar fall further to fix the trade deficit.
Which sounds destabilizing.
Hugely. Massive uncertainty globally. Foreign investors thinking, maybe we should get out of U.S. assets now.
So what are the portfolio insurance computers doing over this weekend?
They're doing their calculations. Cold, hard logic. The market's down over 10% in 3 days. Their algorithms compute. They are way behind on their hedges. Billions behind.
And far behind.
The estimates we saw suggest they calculated needing to sell at least $8 billion worth of futures contracts immediately at the Monday open just to catch up, just to get their insurance back to the required level.
And there's no human saying, wait, maybe this is an overreaction.
Not built into the core programs, no. The logic was simple. Market falling, sell now. They were programmed to unleash that torrent the second the bell rang Monday morning.
And this wave starts rolling before New York even wakes up.
Exactly. Monday the 19th, the crash begins in Asia, rolls through Europe. The global financial system's interconnectedness was laid bare like never before.
The numbers coming in must have been terrifying.
Unbelievable. Hong Kong down 45.8%, Australia 41.8%, New Zealand. The market just basically stopped trading after falling 60%. 60. The FTSE in London was also getting hammered.
So picture being a trader in New York, 8 a.m. Monday morning, watching these numbers pour in on your screen.
Utter dread. You know the tsunami of selling is heading straight for you? That knowledge alone probably intensified the pressure, made everyone even more desperate to hit sell the instant the NYSE opened.
9:30 a.m. Eastern Time, the opening bell, and it wasn't a gradual slide.
No, immediate. Vertical.
Yeah.
Sources describe the floor, normally this model of efficiency, just exploding into, one veteran called it primeval chaos.
This volume must have been insane.
Off the charts. A normal day was maybe 180 million shares. Black Monday saw 604 million shares traded. The system physically couldn't handle it. And the speed was machine-driven. In just the first hour, something like $2 billion of stock changed hands.
Okay, this is where that mechanical accelerator, the feedback loop, really kicks in.
Yeah.
Let's walk through the phases again, because this is what made 87 so different. Phase 1, the PI trigger.
Right. Phase 1. Those portfolio insurance programs, already calculated to be billions behind on their hedges, they execute. They dump that pre-programmed torrent of sell orders into the Chicago futures market.
instantly crushing futures prices.
Because the futures market, while liquid, is smaller than the stock market. It reacts faster, more violently.
Okay, phase 2, the transmission belt. Index arbitrage.
Yeah, the ARB funds.
Yeah.
Their computers are constantly scanning for price differences. They see this huge gap open up. S&P 500 futures in Chicago are suddenly way cheaper than the actual stocks they represent trading in New York.
A risk-free profit opportunity, just sitting there for milliseconds.
Exactly. So their programs react instantly. Buy the cheap futures in Chicago, simultaneously sell the corresponding basket of actual stocks in New York to lock in that price difference.
And this isn't panic selling by humans, it's programmed efficiency.
Pure logic. But that arbitrage becomes the perfect pipe, instantly transmitting the selling pressure from the futures market crash directly into the broader New York stock market. It's the tail wagging the dog, as the Brady Commission famously put it.
The efficiency itself becomes the accelerator. PI sells futures, ARBs sell stocks, a loop feeding on itself at machine speed.
Precisely.
But it wasn't just the logic of the machines causing problems. The technology itself started to buckle, right? The infrastructure couldn't cope.
Yeah, this is maybe the scariest part. The system designed for infallibility failed. The NYSE's electronic order system, the DOT system designated order turnaround, was just completely overwhelmed by the volume.
Orders backed up.
Massively. Delays of an hour, sometimes more. Imagine trying to trade when you don't know if your sell order from an hour ago even executed or at what price. You're flying blind.
And the ticker tape, the prices people were seeing.
Hopelessly delayed. Showing prices maybe an hour old. The most fundamental thing in a market price discovery, knowing what something is worth right now, it just broke down.
How can you trade if you don't know the price?
You can't, effectively. Trust evaporates. Communication breaks down. Phone lines were jammed solid. We found this anecdote. An investor calling from Hawaii placed a sell order on Monday.
Yeah.
Took him 2 full days just to get confirmation it went through. The paperwork backlog was that bad, the system seized.
And when buyers vanish because no one knows the real price.
You hit an air pocket,
Yeah.
free fall, no bids, just offers. It got so bad that the NYSE had to step in and halt, trading in hundreds of stocks.
How many?
195 out of about 250 stocks listed. They were forced into trading halts simply because the sell orders swamped any buy orders. There was no market left for them at that moment.
So this wasn't just a market crash anymore. It was a systems failure, a mechanical breakdown triggering absolute human panic. The machines executing the market itself.
Forcing the humans to literally stop the game.
Okay, the closing bell rings at 4 p.m. The dust settles, metaphorically speaking. What did the scoreboard look like? The damage.
Historically awful. The Dow closed down 508 points at 1,738.74, but the number itself doesn't capture it.
It was a percentage drop.
Exactly. 22.6% in one day. You compare that to the worst day of 1929, Black Tuesday, that was about 12.8%. So Black Monday was nearly double the severity.
The wealth destruction.
Mind-boggling. $500 billion vaporized in the U.S. Globally, the estimates are around $1.71 trillion. Gone. In hours.
Headlines screamed sea rash. People must have been terrified. The whole system was just gone.
Absolutely. We saw that quote from the investor in D.C., just shocked that normal life was continuing outside, feeling like the world had fundamentally broken. The fear was that Tuesday would bring total collapse. Bank runs, everything.
But the world didn't end there. And this is where 1987 really diverges from 1929, right?
Yeah.
Leadership stepped in.
Crucially, yes. The Federal Reserve did not do what its predecessors did in the Depression, which was basically stand by and let the money supply evaporate.
Greenspan was actually out of town, wasn't he?
Initially, yeah. But a crisis group formed immediately back at the Fed, led by Vice Chairman Manuel Johnson. And the FOMC, the Fed's main policy body, started holding emergency calls daily from October 19th through the 30th, just constant crisis management.
And the transcripts of those calls must be fascinating. Greenspan, the objectivist, the non-interventionist, facing total meltdown.
You can see the pragmatism kicking in. He basically says, look, in a crisis environment, we shouldn't really focus on longer-term policy questions until we get beyond this immediate period of chaos. Survival first, philosophy later is a huge pivot.
And they didn't just fiddle with interest rates. They got hands-on.
Very hands-on. Personal human persuasion. Fed officials were literally calling the heads of the big banks in New York, Chicago. The message was blunt. Keep lending.
Don't freeze up.
Right. Don't pull back credit lines just because you're scared. They appeal to their sense of systemic responsibility. Look beyond your own balance sheet right now. Think about the whole system that keeps you in business. They were essentially talking the banks out of a panic, urging them to provide the liquidity the system desperately needed.
Stopping the dominoes from falling.
Exactly. Preventing that credit freeze that could have triggered mass bankruptcies.
And then came the big public statement, Tuesday morning, October 20th.
Greenspan issues this incredibly terse, just 22-word sentence, but it changed everything. The Federal Reserve affirmed today its readiness to serve as a source of liquidity to support the economic and financial system.
The Greenspan put.
The very first one. It was a clear, unambiguous promise. We've got your back. We will not let the system fail. And they backed it up instantly, started aggressively buying government bonds, pumping cash into the banks, cut interest rates.
Everything they didn't do in 1929.
The exact opposite. Providing liquidity when it was needed most, not letting the money supply contract.
So the system is saved. But not by the machine's logic. By human pragmatism overriding philosophy.
Ironically, yes. The guy who believed the market should fix itself had to step in and fix it.
So in the aftermath, there had to be a postmortem. The Brady Commission.
Right. President Reagan sets it up, headed by Nicholas Brady. They investigate. What the heck just happened? Their report was pretty direct.
Pointed fingers.
Clearly identified two main culprits. One, that automated selling from portfolio insurance programs. Two, the way index arbitrage linked the stock and futures markets so tightly, creating one giant volatile system.
The tail wagging the dog.
That became the key takeaway. The system's efficiency had made it dangerously unstable.
And their big recommendation, the one everyone knows.
Circuit breakers, the human off switch, essentially. New rules saying if the market drops by X%, trading automatically halts. A forced timeout.
Designed to stop that mechanical feedback loop we talked about. Give humans a chance to breathe, reset.
Exactly. Stop the machines from running away with themselves. Though even then, it sparked debate.
Health.
Well, proponents said it's essential. Prevents panic. Critics worried about the magnet effect. The idea that if traders know a halt is coming at, say, a 10% drop, they might rush to sell before 10% is hit, actually worsening the sell-off just before the halt.
That debate's probably still going on.
Oh, absolutely.
Yeah.
But they were put in place, a tangible admission that maybe our technology had gotten ahead of our ability to control it.
Okay, let's wrap this up. What's the big takeaway from Black Monday 87 for us today?
I think the core lesson is this really profound warning. We built these logical machines to protect us from messy human emotions, from panic.
And the machines, acting with perfect synchronized logic, created a faster, more devastating panic than humans ever could alone.
Exactly. We didn't survive because the tech was smart. We survived because humans, specifically Greenspan and the Fed, acted pragmatically against their own stated beliefs sometimes to manually intervene, to flip the switch.
And that warning feels even more relevant now, doesn't it? 1987 seems almost slow motion compared to today.
It looks downright quaint. Those DOT systems, dot matrix printers. Now we have high-frequency trading, AI algorithms making decisions in nanoseconds, billionths of a second, faster than our brains can even form the thought.
The complexity is orders of magnitude higher.
Immensely higher.
Yeah.
And the ghost of 87 hasn't gone away. We saw it again in 2010, the flash crash.
Right, the Dow dropped 1,000 points in minutes and snapped back. Mostly algorithms again.
Proving that the speed and automation, while efficient most of the time, still carry enormous systemic risk. The potential for mechanical panic is still there, maybe even more so.
So we put in circuit breakers after 87, but are they enough now?
Well, that's the lingering question, isn't it? Today's market isn't just NYSE and Chicago. It's dozens of interconnected exchanges, dark pools, global trading, happening at light speed. It's vastly more complex.
Which brings us to the final thought for you, the listener, to maybe chew on.
Are we absolutely sure we know where all the off switches are in today's hyper-fast, hyper-connected financial system? And maybe more importantly, if a truly global mechanical panic started unfolding in nanoseconds, could we even reach that switch in time?
And so, another chapter closes. For more journeys into history's forgotten files, please like and subscribe. Your next story awaits.